From the campus of Yale University, this is Business Talk with Jim Campbell, nationally syndicated across the country on the Biz Talk Radio Network and coming to you from our flagship stations, Yale Radio WYBC and 1490 AM WGCH Greenwich. All talk and all business, 60 minutes of radio with leading figures from the world of business along with the business of politics and sports. Bethany McLean is co-author with another friend of the show, Peter Elkind, of the bestseller The Smartest Guys in the Room, The Amazing Rise, Scandalous Fall of Enron. Her second book, she was on the show for All the Devils Are Here, The Hidden History of the Financial Crisis. She joined us for Shaky Ground, The Strange Saga of the U.S. Mortgage Giants, contributing editor at Vanity Fair. She investigated the Valiant drug pricing scandal, which we discussed on the show, and she was on for discussing insider trading on Wall Street and false charges against a hedge fund manager. And the latest work is Saudi America, the truth about fracking and how it's changing the world. Welcome, Bethany, from Chicago, my hometown originally.
Thanks for having me.
And let's jump back into the fracking world. Bethany, is energy independence a great thing for us? It would seem it is.
Well, I had thought it was, but what I came to believe when I was researching the book was that it's a set of words, a phrase that doesn't actually mean anything. It's been around since the 1970s when we first began to be scared about our dependence on foreign oil, and president after president has repeated it like a mantra, energy independence. But when you actually look underneath those words and try to figure out what they mean in a modern economy, they mean a lot less than they look on the surface. And what I mean by that is that back in the 1970s, the Texas Railroad Commission could set the price of a barrel of oil. America could be independent from the world swings. These days, the price of oil is set on the global markets. No matter how much oil we're producing here, what Americans pay at the pump is going to be influenced by events around the world, from Liberia to Nigeria to Libya, and that's the way it is. So we can't be independent of that. Secondly, in a global economy, even if America doesn't need the oil that's being produced, say, by the Middle East, our trading partners in Asia and elsewhere need that oil. So if we were to, energy independence to many people means we don't have to care what happens in the Middle East. We no longer have to spend our energy and manpower trying to police that part of the world. We can just walk away. But we can't, because there's a great analysis I found that 6 of our 10 top sources of imports, many of them high-tech goods that our technology sector is heavily dependent on, are Asian countries that themselves are heavily dependent on Middle Eastern oil. So we can't walk away. It's in a global economy, it's kind of a myth to say we're independent.
Looking at geopolitics for a second, the Saudis, war in Yemen, killing Khashoggi, Russia oil has a chokehold on Europe, and we all know about Putin having folks killed on foreign soil. You don't think we should play that card a little bit more to help destabilize both those countries, or it doesn't make sense?
I don't think we can play that card when it comes to oil. No matter how much America produces, there's not even the most aggressive production estimates in America don't say we're going to be able to cover all of our own needs, let alone the world's needs. And the Obama administration was actually quite conscious of the idea that we always told these other powers not to use energy as a weapon, and so to do it ourselves would be hypocritical. Now, of course, they have used it as a weapon, so you can argue that some of this could be good, particularly natural gas. And I think natural gas and oil are very different, and people lump them into the same category, and they're not at all. While it's unclear how much oil we have, and the price of oil is set on a global market, as we've talked about. Natural gas, everybody agrees we have a really long-term cheap supply here. And there is a thought that if we can export natural gas to Europe, we can break some of the stranglehold that Russia has long had on Europe's need for natural gas. But that's still very much in its infancy. We are just now building the terminals to export natural gas, and Europe doesn't yet have the capacity to receive it in great volume. And our natural gas is still a lot more expensive than Russian natural gas because of the cost of liquefying it and then regasifying it.
I'm going to do a little bit on gas and oil later because it's interesting, the difference. I'm a big Buffett man, so I was interested that you quoted Charlie Munger, his partner, as saying imported oil isn't our enemy. What does that mean?
So, yeah, it's funny. I'd heard that Charlie Munger had strong views on this.
Yes.
So I reached out to him because if you can talk to Charlie Munger, why wouldn't you, right?
Yeah.
And he was eager and willing to talk about it. And he argues that because there's still no substitute for oil, for hydrocarbons in certain really critical aspects of modern life. So put aside energy security, food security. There's no substitute for hydrocarbons in fertilizer, and the use of fertilizer is what has enabled our yield per acre to expand so dramatically. So his argument is, without hydrocarbons, we couldn't feed our population. And what are we doing, digging this stuff out of our ground, or rather, fracking this stuff out of our ground as quickly as we can and depleting our supplies when there still is no substitute for this? And wouldn't it be smarter to import oil and to make sure until there is some kind of substitute, if there ever is, that we have a supply here on our soil? His argument was that hydrocarbons are like the topsoil of Iowa. You wouldn't want to use them as quickly as possible. You'd want to use them as slowly as possible.
Fascinating. I would only challenge in the sense that especially in the 70s, when oil prices by the OPEC nations shoot up, it really affects our inflation, which is a bad thing. Tell people, because I don't think a lot of people really know, what is fracking? What does it mean?
So it's a way of getting oil out of so-called tight rock that is too dense for hydrocarbons to flow through it the way they would in a traditional vertical well. And so what you do instead is you drill horizontally, and the technological feats are actually quite marvelous. Wells can go as much as 3 miles horizontally now, and then it's sort of fracking is sort of like, somebody likened it to me like filling a building up, locking all the doors and yelling fire. And people try.
That's a great analogy when you.
It is, right? And people try to get out in whatever way possible, and that's what happens when you inject this mixture of liquid and chemicals into the rock at really high speeds. You force, and you use sand to prop it open. You force the hydrocarbons up through that would never come out of the rock before, up through the rocks, and it turns out you can get this in enough quantity that you can make money on wells, arguably.
All right, there's some great insights that I learned out of this book. There's a couple I want to talk about now that, and they're threats to energy independence if you look at it that way. But the economics and the sort of underappreciated role of Wall Street and this fracking industry sucks capital and not a lot of free cash flow, which surprised me. Talk about that.
So that was one of the reasons that I was so interested in writing this book, because fracking is changing the world, right? A guy I quoted calls it one of the top 5 things changing geopolitics. It is a really big deal. It is changing energy markets globally, and yet the industry doesn't make money. It has not traditionally produced free cash flow, and so the argument is, how sustainable is this? What would American fracking boom look like if companies had to live within the cash flow they produced? And one of the fascinating pieces of analysis I came across was this idea that if it weren't for the global financial crisis, it's not clear we would have had a fracking revolution of the size and scale that we did. And what that argument is based on is the idea that fracking is so capital dependent that it took super low interest rates to enable fracking companies to raise the mammoth amounts of cheap capital that they needed. And of course, the Fed dramatically slashed interest rates in the wake of the financial crisis to spur the economy. And cheap capital has had lots of ripple effects in lots of areas, but one of them is definitely fracking. So there's this relationship between the global financial crisis and fracking that most people don't realize, and also this ongoing reliance on Wall Street to continue to fund these companies. I think most people think of fracking as being done by entrepreneur, wildcatters down in Texas, and it's true to some extent. Many of the people who run these companies are fantastic characters, but there's also it takes Wall Street in a big way.
Where are you on the trade-off between fracking? We need the growth coming out of fracking and the environmental issues.
In my book, I didn't tackle that question because it is a mini book. It's meant to be a short, quick read. A friend even told me he read it on the beach. Nobody's ever told me my book.
Yes, it's nice. Just like the mortgage book.
Exactly.
I mean, the mortgage Fannie and Freddie book.
Oh my goodness, no. So I deliberately stayed away from the environmental question, but I obviously think about that a lot, and I think it's a really hard question, and also made more complicated by the fact that the age of renewables is coming, and if we invest heavily in all of this immense and dirty capital equipment required to transport gas, oil, and natural gas and ship it overseas and refineries. And there's this talk that Pennsylvania is becoming the new land of plastics. Back to The Graduate, right? One more plastic.
You're showing your age there.
Exactly. that if it's, and there's an argument that although natural gas has dramatically reduced the switch from coal to natural gas has reduced our carbon emissions, frackers let off something called methane, which is arguably worse for the environment than carbon dioxide is. So it's real, and yet at the same time, the fracking boom has provided jobs to areas of the country that have needed them, and has given our economy a boost at a time after the financial crisis when we desperately needed that.
All right, we'll move into a little more fun, and since we'll put a face on this, the poster boy for excess. Back with investigative journalist Bethany McLean. The metrics of this, because it's not producing cash flow on Wall Street and private equity firms, he's just dumping stuff in here, and of course Wall Street getting billions of dollars of fees over all the debt and equity issued. Is this like a dot-com boom waiting to happen, or what do you see?
So one of the humbling things about working on this book was I realized that everybody who has attempted to predict the future of fracking or the future of oil generally has usually been dead wrong. And so I have quite a bit of humility about my ability to predict the future. And look, there is an argument that it's all going to work. Fracking's only been around for about a decade. There's an argument that technological improvements are going to enable companies to get more oil and gas out of the rock at lower cost, and that's going to make what wasn't economic highly economic. That said, and companies did the better companies did produce a bunch of free cash flow in the third quarter. But at the same time, there's also an argument that that the number of great wells, the amount of great geology in the U.S. where you can get this oil out at really low prices is not as much as people think, and so it's not clear how long that's going to last, and that would be the skeptical take on it. I don't know that it ends in a mammoth blow-up of any kind. To me, the key question is almost more existential, which is as we start to believe that we're this oil and gas superpower, particularly oil, is that really true? And shouldn't we have some humility about that and about how long it might actually last? And what does the world look like if Wall Street stops funding this and companies have to live within the cash flow they can produce? Are we an oil superpower after all? And that, to me, is the really important question.
Interesting. It always bothers me, too, when Wall Street has sort of a conflict of interest, because how do you turn down $1 billion of fees? But you're also pumping a lot of debt and equity out there that may not be sustainable, really.
Right. Well, people have said to me, well, that doesn't make sense because Wall Street wouldn't finance these companies if they weren't making money. And I said, remember the subprime mortgage boom? Wall Street can make money even if something is not good even if something isn't economically sustainable in the long term.
I think we saw that in 2008, didn't we?
I think we did. And Wall Street, and more to the point, Wall Street will make money even if something is not economically sustainable in the long run. They don't care. They don't have any long-term sort of sense of this. If they can get fees, they will.
Let me add, when I was in business school, I was blown away by a professor who was an expert telling me that the marginal cost of a barrel of oil coming out of the Middle East then was 10 cents a barrel, and the rest was all profit and country's taxes and stuff like that. And it's still like $10 a barrel that you say. Where is the fracking break-even price along those lines?
So this is a complicated question, and I'll answer the American part of it first. But nobody actually really knows. I read a piece in Bloomberg the other day that said companies are making money even at $30 a barrel. But companies aren't making money. And so companies have always had this. They've said we can make money at $40 a barrel. We can make money at $30 a barrel. And then you go and they show you these wells that are producing 80% internal rates of return at these really low prices. And then you go to their corporate financial statements and they're losing money. Yeah. And so wait, what happens? What's the difference between the return at the wellhead and the corporate return? And it turns out there's a big difference between those two numbers. So that's one thing. The other thing is that the break-even price is heavily influenced by by a lot of things, but two big factors that are really variable. One is where you drill a well. So ever since the days of Aubrey McClendon, there's been this desire to make fracking this predictable thing. McClendon used to call it manufacturing, this notion that you could just stamp these wells one after the other, and they would be exactly identical like widgets. But they're not. The Earth is a lot trickier than that. And so even a well a mile away from another well may be really different in terms of the amount of oil it produces and what it costs to get that out. So this notion that there is an average break-even, well, I guess there is, but it's one with an amazing amount of dispersion around the mean, right? And then the second part of that is that service costs are a huge part of drilling a well, and they are wildly cyclical. So when the price of oil starts to climb, service costs start to climb as well. That didn't happen yet in this last boom before prices started to sink again, so it made the break-even costs look lower than they would be if service companies had time to start inflating their costs again. So that's the other component. So when people talk about break-even costs, it's this attempt to pull an average out of something where there really is just wild variability.
Too much dispersion at the mean. That's interesting. One more question right now on sort of this technical stuff, and then I want to get to the fascinating billionaire McClendon. But it almost seems from a technical point of yield that it's like a Ponzi scheme. More and more capital is needed to get the same supply, because the depletion rates on these things right now, 70%, you see in year two, they get 85% less out of the well or the fracking in year three, and it's 10% in oil. So that's a big issue.
Yeah, the depletion rates are the reason that that people argue that this industry will never be economically viable, and that's exactly as you said, because the amount of oil that comes out year two and then year three is so much less than year one. Unlike when you drill a vertical well, it generally produces, there's a decline rate, but it's not as steep. It produces for a long period of time. Fracked wells, on the other hand, decline radically. So if you want to keep your production levels constant or growing, then you have to constantly reinvest, and it's a treadmill from which it's not clear there's any end point. It's not clear that at a certain point, you can stop investing, right? If you stop investing, your production goes away.
The economics of natural gas versus oil fracking are a big difference, right?
So there's an argument that natural gas fracking is actually more economic than oil. And fracking started with natural gas. It wasn't until the price of natural gas cratered that people really started to frack for oil in big numbers. And there was a belief for a while you couldn't frack for oil because oil molecules are bigger and it's harder to get them out. And maybe there's still some truth to that, in that the decline rates on fracked natural gas wells, while still steep, are nowhere near as steep as oil wells. The price of natural gas has been really, really low since fracking started in earnest, so it's not exactly been a gusher of profits for companies, but there's an argument that even at super low natural gas prices, some companies are starting to make money. Whether or not that's a good thing environmentally is a huge source of debate, but there is an argument that at least economically, natural gas is closer to making sense than oil is.
Now, becoming a net exporter would be a great thing, right? But you have to build these big regasification plants that suck capital up as well.
Right. So that's the hurdle, is that the process of turning the natural gas into a liquid so that you can ship it overseas and then regasifying it on the receiver shore is a hugely multi-billion-dollar capital-intensive program. And some people have done it. We've got it's happening, and it will probably continue to happen. And I think in some ways, as we talked about earlier, given the potential to at least give Europe an option to Russian natural gas so that there isn't quite the stranglehold over European supply that there has been for decades, that could be really positive.
First off, we want to wish everybody a happy holidays. Thank our loyal listeners. We want to thank all of our loyal listeners again. Business Talk with Jim Campbell. Happy New Year, everybody. And we're back with investigative journalist Bethany McLean. And You put a chunk of the book around this reckless billionaire, Aubrey McLean, who's just a fascinating character. And first off, did he commit suicide?
So that's always going to be the debate, right?
Because it seems like he did, right?
Most people think that he did, although the police department in Oklahoma City ruled it an accident. And the investigator said the truth is we'll never know 100% what happened, and I think that sums it up best.
Okay, so now to put it in perspective for people, tell us a little bit about him.
So I chose to focus on Aubrey McLean because he's one of those great larger-than-life characters who comes along every so often in the business world and really arguably changes the world, even if aspects of the person might not be all that appealing. So Aubrey McLean was the CEO of a company called Chesapeake Energy, which was probably in some ways the pioneering natural gas fracker, and at one point produced more natural gas than any company other than ExxonMobil in the U.S. And while Aubrey wasn't the technology pioneer, the person who figured out how to do this from a technological perspective, he was the father of raising capital. He was the guy who was able to go around the globe and convince investors everywhere that they should pour literally hundreds of billions of dollars into American fracking. And the guy I talked to early on, who was a skeptic of McLean and of fracking, said, I never let him in here for a meeting. This was an investor at a big buy-side firm in New York, and he said, I never let Aubrey McLean in here for a meeting because if I had, we would have ended up buying a ton of stock, and it would not have ended well. McLean was also one of those very few characters who was willing to risk every penny of everybody else's dollar, and he basically went bankrupt 3 times. But he was also willing to risk all of his own money, and that to me makes him somewhat unique. And so he essentially died bankrupt. His estate was tied up. He secured so much of his fundraising with personal guarantees that his estate was tied up in probate court for a couple of years, but it ends up that creditors are not getting 100 cents on the dollar.
Was he a con man, or?
Well, he was one of those con men who was also conning himself, if that was the case, because did he believe, particularly in the power of natural gas to change the world. He believed, and look, he produced, unlike other con men, he produced a product. It's not like he was taking people's money and not trying to produce vast quantities of natural gas. He was, and he did, but the economics of what he did never worked.
And he went through something like $80 billion in capital?
So I counted up for Chesapeake during the period where he ran it from 2001 to 2012. The company raised $30 billion in debt and equity from Wall Street and paid Wall Street $1 billion in fees, and that was just what was on the surface. The company raised at least another $30 billion by selling assets and by doing these Enron-esque prepaid deals where they'd sell their future supply of natural gas in return for upfront cash. And so altogether, $60-70 billion that he burned through during that decade.
And no positive cash flow.
No positive cash flow. Yeah.
Did you see, having been obviously the Enron expert, did you see a lot of Enron stuff there? Off balance sheet thing, moving stuff around?
Well, it's hard. There was not the degree of financial chicanery at Chesapeake that there was at Enron. There was conflict of interest chicanery, where McLean, for instance, had a share in the wells, a personal share in the wells that Chesapeake drilled that enabled him to profit from that, and he had to finance that, and so he took out loans from people who were also lenders to Chesapeake, and there was also, and he was, his board paid him. He made him the highest paid CEO in America in a year where the company had lost like 80% of its stock value. I mean, there was all sorts of chicanery around that, but not so much. You could look at Chesapeake and see what the numbers were. And he was a promoter. There was this infamous period in the early 1990s where Chesapeake almost went bankrupt, in the mid-1990s, actually called the Austin Chalk, where McLean was just a huge promoter that this area was going to be the natural gas center of the United States. And after a few years of heavily promoting it and touting the wells there, the whole thing crashed and burned and fell apart, and Chesapeake stock went under $1 a share.
Now, this is a huge failure of corporate governance. I can't believe he was allowed to buy stock on margin debt, so they knew that he was hung out there, as you said, by some of the banks, and he got this 2.5% profit out of every well. And where's the board here?
Well, the board for many years was mostly friends of Aubrey's, so the board was not inclined to crack down. And then there was this huge uproar around the 2011-2012 timeframe after Reuters did a series of really excellent investigative reporting pieces on Aubrey's deals to get this 2.5% of every well that was drilled and other problems at the company, and that led to this hue and cry. And new board members came in, and people thought they could turn Chesapeake around, and McClendon eventually got kicked out. But I think it's still debatable today whether Chesapeake will survive.
Why did he overpay for land so much?
He had this belief that this was the great American land rush, and that the most important thing was buying leases everywhere you could, because whatever company controlled more leases and more land was going to control natural oil and natural gas. And so he completely didn't distinguish between good land and bad land and how much it cost, because he thought all that mattered was accumulating it. There's this great quote on a conference call where someone asked, Aubrey, when is enough enough? And he said, I can't get enough.
And he did have his own money tied up. You have his net worth going from $2.5 billion to negative $500 million. He
did. So he basically went bankrupt 3 times. The first time was over the Austin Chalk episode where...
Almost Trump level.
Where Chesapeake, that's hilarious, where Chesapeake lost all of its market value. Then the second time was in 2008, where he had all of his stock was on margin, and so when Chesapeake stock crashed, the banks, Goldman Sachs in particular, called in his margin loans, and he lost everything. He went from being on the Forbes 400 list, I think he was number 200 or something, with a net worth of over $3 billion, to being essentially broke. And then after he got kicked out from Chesapeake, he was able to raise another $15 billion from private equity investors to create this thing called American Energy Partners, which was supposed to be this collection of 5 or 6 different companies, from natural gas to oil, in the U.S. and Argentina, et cetera, that was going to be a fracking powerhouse in essence. And that started to crater as well, just before he died in the spring of 2016.
Now, talk about this big game changer in the Permian Basin in Midlands.
So that's one of the things that brought about the resurgence of American fracking after this death knell. And it really was. When Aubrey died in the spring of 2016, it looked like the exclamation point, sort of signifying the end of the fracking boom, because companies were going bankrupt, debt was heavily distressed, drilling had really slowed down dramatically. It looked like it was over, but companies had started to drill, to frack in the Permian Basin, and it's really funny. Nobody was able to give me a good answer to this, which is, why did it take so long to frack in the Permian? And what I mean by that is, everybody's known there was oil in the Permian. It's been, the gusher of American oil dating back to the 1930s, when people started drilling there. It's the epicenter of American oil, Midland, Texas, right? But people didn't frack there until 2010, 2011 in earnest. And an old-time oil man said, the Permian is like the girl next door. You just don't really look at her until suddenly you say, oh my goodness, that's where it's at. And it turned out the Permian is essentially just tailor-made for fracking, because there are these areas of it where the oil and gas is stacked in layers like different carpets. So it makes it far more economical to frack there than in other so-called shale plays. And so that was one of the things that led to this comeback in fracking after the events of 2015 and 2016. People even call it Permania, which I think is a great name. But the price of land there has just escalated. It is definitely a bubble. It used to be, you could lease land for $10,000 an acre, and I think a recent transaction was almost $100,000 an acre.
And the numbers are staggering. 75 billion barrels potential there, bigger than Saudi's biggest areas.
Well, that's what the proponents say.
Oh, how do you see the trade-offs between throwing this tariff war on the table, trying to bring coal back, along with what his goals are? I mean, are they totally in conflict? And is it a big issue that we don't have any U.S. energy policy ever?
I was going to say, I think the word is more incoherence rather than conflicts. But if I were to be fair to the Trump administration, I would point out exactly what you just did, which is that while we don't have any kind of coherent energy policy in this administration. We actually never really have had an energy policy, so it's par for the course in that sense. But yeah, the whole idea of bring coal back, that the Obama administration killed coal with its, quote, war on coal, is just crazy. What killed coal is actually fracking and the advent of cheap natural gas, and that's what has killed the coal industry in the United States. Not any kind of action taken by an administration. So it's really quite incoherent that Trump is talking about energy dominance and trying to enable more fracking at the same time as he's trying to bring coal back at the expense of natural gas, which is strange. And then the other part of the incoherence, I would say, is the Trump administration's plan to unleash yet more drilling in places that were formerly protected. Because right now we don't need more supply. More supply is just going to push the price down even further and make it even harder for these companies to make money. And so why you would do that, just to me betrays a total lack of understanding of the economics of fracking.
We'll be back with our final segment with Bethany McLean right after this. And we've been looking at the global energy perspective with Bethany McLean. Now, you said how hard it is to predict, and you want to be humble, but you talk about three sort of cases that you could see emerging. You want to go through those a little bit?
Yeah, so I think what was really interesting to me was the difficulty in predicting how this is going to shake out, and the most kind of honest answer I came to was from this firm called IHS Energy Market, which is a energy forecaster, researcher, et cetera. And their idea was like, look, we don't know how this is going to play out, so we're going to look at these three scenarios. And one is this idea that renewables come along a lot more quickly than anybody expected. Another idea is kind of status quo, that things continue to play out. And the third idea is that renewables don't come along as quickly as people expect, and that oil, that our supplies of oil turn out to be a lot more limited than people think, leading to this period of really sharp price hikes. And so it was just this way of thinking about it through scenario analysis, which I thought was the most practical and humble and intelligent way to look at this in the face of how wrong most people's ability to predict the future of this has been.
Do you attach a high risk to the worst scenario, the last one?
I think there's some risk that turns out to be true. There is an argument that as it has looked easier and easier to get oil from fracking, that we have underinvested in some of the big complex projects that would have produced oil, and that by the time we figure out we've underinvested in those projects, it's going to be too late, and we're going to enter a period of higher prices. So you can find intellectual validity to any of these arguments, essentially.
Do you think that the technical improvement on the depletion rate, that yield thing, is going to happen and is going to make a big difference?
I honestly don't know. I think it will not make as much of a difference as people think, if I had to guess. And again, I'm going to caveat this by saying I'm not saying this is absolute truth. This is saying if I had to predict it. I think the argument that there are fewer areas of really good geology than most people think is the most compelling one to me. And so that technological innovations are going to make less of a difference than people think, because the idea that there's this plentiful supply of great geology that is willing to lend itself to fracking, I think is going to prove to be untrue. And I think the supply of really great land is going to be less widespread than people believe.
So is this fracking boom more fragile than it looks? And we talked at the beginning that, is Wall Street going to keep funding this, and interest rates are going up?
I think it's way more fragile than most people believe, because it is so heavily dependent on capital, right? Anything that is dependent on external capital is then dependent on the cycles of the capital markets. And so that it doesn't mean that people are going to stop funding it tomorrow, because those things are as hard to predict as geology is, but it means that there's a risk there. This thing is not self-sustaining.
And will valuation change to profit, in other words, I guess?
And there's some of that going on already. So fracking companies have had a terrible time in the public markets because this pressure on them to start producing profits started a couple years ago, where investors started to say, whoa, wait a minute. We're not doing this anymore. If you're not producing cash flow and giving us a return, we're not investing. And so fracking stocks have actually, for all the hype and hullabaloo about the Permian Basin, fracking stocks have not done well for that reason. There's been this intense focus on capital discipline and on returning money to shareholders, and they have. But how much inventory like that is there? And that's going to be the question in front of us for 2019.
So I don't know if I have this right, but I think you say that as of around now, we produce like 11 million barrels a day, and we consume 20 million barrels, so that's 50%. And do you see that production level going so high that we close that gap and more?
I don't think so.
You don't think so?
No, I very much would doubt that. And there are predictions that the production level will go much, much higher. But if I had to guess, and I'm going to give a caveat to my prediction in a second, I think those estimates are going to turn out to be of huge growth, continuing, like a hockey stick into the future, are going to prove to be wildly exaggerated. And here's the caveat, which is that there is ongoing work. EOG, for instance, is working on getting oil out of rock other than shale, different kinds of rock. And so technological advances that enable us to get oil from other places that people never thought you could. That's always a possibility, right?
Did you have fun doing this? Did you go into the Permian Basin and all those wildcatter guys?
I did. I had a lot of fun doing this. I have a lot of respect for the entrepreneurs who have created this business and put their literal blood, sweat, and tears into building something that for a long time a lot of people didn't think was possible. And part of the reason I wanted to write this book was that on the coast we tend to have this ignorance of energy and this myopic fascination with things in Silicon Valley, the latest app to deliver your dry cleaning, for instance. And I thought this stuff going on in these places in the world that people in these places in the United States that people on the coast don't even care about, whether it's the Permian Basin in Texas or the Bakken in North Dakota. This is what is going to shape our future far more than the latest app to deliver your laundry. This is where it's at. This is what we should be caring about. And so that's exploring that and trying to figure that out was part of the reason I wanted to work on this.
But it's not going to be a revolution in geopolitics.
Well, I don't think it is. I think the oil that we produce this burst of oil that we're producing is going to be more short-lived than most people think it is. I think natural gas could turn out, our supply of natural gas could turn out longer term to have more profound consequences. And I think if we were to have an energy policy in this country and start encouraging the switch of transportation to natural gas, that could have an even more profound impact, because that does start to make energy independence real. One of the things that struck me in working on this book was the number of really smart private equity people who, some may still be investing in oil and gas, some weren't investing in oil and gas at all anymore, because the dawn of the age of renewables is coming. The question is when, and that's as complicated a calculus as predicting the price of oil, if not more, since the price of oil is one of the variables into the dawn of the age of renewables. But it's coming. There's already an argument that wind and solar can be cheaper than, without subsidies, can be cheaper than hydrocarbons. And I also worry that if we're myopically fixated on this notion of American energy dominance, that we're going to fall behind in the race to develop renewables. And
interesting.
That will leave us leaders in the world as it was, but perhaps laggards in the world of the future.
All right. Have you got a next thing coming or another one of these short kind of analyses?
Not right now. I'm working on a piece for Audible, which is now doing its own content. If you're an Audible listener, and they're doing their own original content, and so that should be fun, and that's my next project. Got it.
Always a lot of fun, another brilliant analysis you put together. And the book is Saudi America, The Truth About Fracking and How It's Changing the World. Thanks to Bethany McLean. We'll see everybody next Monday for another edition. And welcome now to our segment 5, which is Overtime. It's exclusively for Yale Radio. Bethany McLean has been on the show to discuss her excellent book of The Financial Crash, which was All the Devils Are Here, The Hidden History of the Financial Crisis. She's also the co-author of one of the best business books ever on Enron, The Smartest Guys in the Room. More recently, she wrote Shaky Ground, The Strange Saga of the U.S. Mortgage Giants. That was about Fannie and Freddie, and we interviewed her about that. Roddy Boyd is the founder of the Southern Investigative Reporting Foundation, formed in 2012 as a nonprofit with the goal of providing in-depth financial investigative reporting for the common good. He's the author of Fatal Risk, a cautionary tale of AIG's corporate suicide. He was a guest on the show for that. It was the 2011 Financial Times Goldman Sachs long-listed book of the year for business. Welcome back, Roddy. And Roddy, originally from Greenwich, I Kid Coscob in particular, and Bethany from my original hometown in Chicago. How are you guys?
We're doing great.
This is coming from the Netflix Dirty Money series on Valiant price gouging, so for folks can go out and take a look at that. It's really excellent. Bethany, just to start off, in the big picture sense, is there this big dark side of big pharma, or were these just bad guys?
I think there is a big dark side of big pharma, and these are, in a way, the epitome of it. But what to me is interesting is the name most people in the country know is Martin Shkreli, right? He's the guy who infamously jacked up the price of this life-saving drug, and he went to prison on unrelated actions, and he was sort of smirking, and he was called in front of Congress. And I remember sitting with an investor, a big Wall Street guy, who was telling me how horrible Martin Shkreli was, and I looked at him and said, well, why is what Valiant's doing any different? And he looked back at me and he said, well, that's a good question, because they were doing exactly the same thing, that is, jacking up the price of life-saving drugs. But for some reason, Wall Street loved them because they were making money for people on Wall Street. And to a lesser degree, this is what all of the pharmaceutical industry has been doing for years.
Okay, so tell us a little bit about the backstory of this and Michael Pearson in particular, the CEO, and what they built.
So Michael Pearson was an ex-McKinsey guy, oddly enough, just like Jeff Skilling of Enron, an ex-McKinsey guy, who came to take over this really struggling, failing, small-time Canadian drug maker. And Pearson turned it into an acquisition machine, and he sold the story to Wall Street as this ability to not only buy other companies, but also to do things without R&D. So if you strip the cost of research and development out of the drug business, the cost of actually developing new drugs that might save people's lives, his argument was you can have a much more profitable business, and we'll just buy drugs instead of spending the money on R&D. And that was just one example of ways he came up with basically to kind of game the system. He also did a thing known as a reverse merger with another company that enabled him to have the lowest tax rate, I think, in corporate America. It was around 4 or 5%, incredibly low. And he built this machine that Wall Street loved. They thought he was a demigod, and he had some of the most famous investors and supposedly the smart money invested with him. But one of the things he did that skeptics pointed out was actually just acquire drugs and then boost the price on them so he could strip more profits out of them. Before we go a little bit deeper in that business model, tell folks an example that hits home that, actually folks who needed drugs to survive, like Cyprine, what he did to the pricing there. Very rare disease called Wilson's disease, where your body can't metabolize copper, so it stores in your liver and you die. And there have long been, since the 1950s, a couple of drugs that will treat this, known as cupramine and cyprine. And cyprine is kind of the gold standard of the two drugs. And they were owned by Merck for a while. They were very, very cheap, maybe $1 a day. They'd been developed basically in a basement by a British pharmaceutical guy in the 1950s. There wasn't some big, complicated, multi-billion-dollar investment required to develop these drugs. And Valiant ended up buying them and boosted the price of cyprine to over $300,000 a year. And his argument was always that, well, the insurance will pay for it, right? So this is the insurance system. But of course, that's a false argument because A, we're all the insurance system, so if the insurers are paying for it, we're paying for it. And B, there are people who can't get insurance, who therefore couldn't get their life-saving drug. And then C, there are people who do have insurance, but because of this situation with the drug, are absolutely live in panic of losing their jobs or having their retiree plan change their insurance program, because even if they've done well in life and have good savings, if you have to pay out of pocket over $300,000 a year for the drug you need to save your life, you're done. You're wiped out.
Going back to the business model, Roddy, I want to ask, when I first heard that, it sounded brilliant. You strip out all the R&D costs, you raise the price, it's an automatic home run. But you think about it, it means that you have to keep bringing in more and more companies because as you take out the pipeline and you suck up the short-term profits, you got to go find something else. And that's a Ponzi scheme, isn't it? Eventually they would have had to own every pharmaceutical in the world.
Well, yeah, I mean, and credit where it's due, I guess. They were getting there. I think, from 2009 through the end of 2014, I think they purchased 109 or 110 pharmaceutical companies. And, I mean, it's just a mind-boggling amount. And when you actually think of running an enterprise trying to consolidate 110 separate, payrolls and benefit systems and human resources. I mean, you really have a sort of a colossus that's out of control. I mean, they'd grown so fast, they weren't even paying bills in certain places. I mean, it was truly out of control.
Does it seem like Tyco and all? I remember interviewing Kozlowski, and these guys wanted to be top 5 in 2016. Was it another Tyco?
Certainly that business model. I mean, they were very proud. I mean, in the Netflix series, there's great footage of Mike Pearson saying, we're in the market. He was not shy about saying that, to your point, he wanted to be top 5 across a series of categories, and was very driven by acquisition. And to that end, I mean, you're absolutely right. It was a logical impossibility. Eventually, they would have purchased everything that, held itself out to be a pharmaceutical company.
Which leads me to ask, wouldn't that be obvious to Wall Street? I mean, these guys were the darlings. The stock price went up to $260, worth $90 billion. Didn't it seem an asset stripping or whatever you want to call it, financial play? Shouldn't it have been more obvious? Put it that way.
Yeah, of course. and to some people, it certainly was. As Bethany and I wrote, in different publications. I mean, it very, very demonstrably was a business model that had massive flaws, but the stock price kept on going up because they kept on, reporting larger revenue. They had all these customer, what they call bespoke metrics, these non-traditional accounting measures that they kept on hitting because they kept on purchasing, more and more companies. Absolutely. I mean, it was a very circular series of arguments that we'll keep on growing, and as long as growth is there, Wall Street analysts could be readily persuaded. More to the point, they provided large amount of fees to Wall Street's investment banks for mergers and acquisitions and arranging bank lines and so forth.
I was going to say that it also, when I wrote about the company, I struggled with this very question. Why, given the obvious flaws in the business model, people who were big believers in this company were the supposed smart money? It was a well-known value investment firm called Sequoia. It was Bill Ackman's Pershing Square, and Bill Ackman at the time was regarded as one of the best hedge fund managers out there. It was all of these companies all these hedge funds known as Tiger Cubs because they're offshoots of the famed Julian Robertson's Tiger management. And so these were the supposed smart money that were the big owners of the stock, and they were the people who would normally have been skeptical. And what I finally decided was that it was in many ways a cult of personality, and the cults of personality are the most dangerous stories on the street. And it was a cult of personality around Mike Pearson. These these people just believed in this guy. They thought he could make them money. They saw in his, and he was a guy who was rough around the edges, but they saw in that sort of the signs of somebody who was a truth teller, and they liked the way he had figured out how to game the system, and they thought, I think, that he would game the system to their advantage. But it was a cult of personality in a way that I don't know that you can ever fully understand cults of personality.
All right, and as we end this segment, August 5th, 2015, Valiant's stock price reaches $262.52, up from almost nothing. The CEO, Michael Person himself, is worth $2.5 billion. It's a house of cards. That's what we're going to find out next. And we're back. Our guests, Bethany McLean and Roddy Boyd, both renowned financial investigative journalists. And when we last left before the break, we were looking at valued at its peak $90 billion value. We're going to see this disappear almost overnight. But, Roddy, this was a house of cards. You became the detective that really broke this on Philidor. Take us through the story.
As you noted, in the summer of 2015, Valiant Pharmaceutical International was perhaps America's highest flying company, was worth $90 billion, its stock chart looked sort of like like you were charting a moonshot. It was sort of straight up and had made a lot of people a lot of money. About that time, I had been following the company, as Bethany and I noted. It had been something of a controversial moonshot because it did have a chorus out there of naysayers, these short sellers and skeptics, and they were quite vocal in their disagreement with the business model of the company, saying that there were any number of what they argued were fatal flaws. I'm an investigative reporter. My job isn't necessarily to sit there and be a referee. So what I did is I did my own work. I sat down and decided to try and understand the company. My sense after having done this for a lot of years was that there was a story there, but I simply didn't want to parrot one side or another's version of the facts. So I started digging into the company, and I soon found out that the framework, the outline of the short argument, the short seller brief, as it were, was that it was, this was a roll-up, a company that was simply vacuuming up dozens of other companies and wasn't able to grow organically. But in and of itself, of course, that's not a crime. I think it's a flawed business model. But one kind of sleepless night in the late summer, I had come across on a message board called cafepharma.com, was sort of an industry site for pharmaceutical representatives to go and drop the dime, as it were, on, this company's sales aren't really all that, or this company's doing really good business because we've got a hot new drug. And, it's sort of like a fan site for pharmaceutical representatives. And in scrolling through the Valiant page of Cafe Pharma, I came across a couple of Valiant salespeople just asking one another a question in the open, saying, what's Philidor? What is this company? And I was like, what is Philidor? I makes no sense. And one guy posted, basically it's this kind of workaround to keep the prices high. And I was like, wow, that's really interesting. So I managed to reach out and have a conversation with one of these posters. And we went back and forth. The guy didn't want to go on the record or anything, but he said, he had asked the question of his boss, what is Philidor? And his boss pulled him aside as if he had, tried to spill the keys to the kingdom, as it were. And he said, whatever you do, don't be asking that question in public. Philidor's the secret sauce to this company. It's how we keep our prices up. The insurance companies will kill us if they ever find out. The orders are from on high. Don't be discussing Philidor. just do what you're told and everything's going to work out just fine. Well, that struck this guy as really weird, and he eventually wound up leaving the company in short order. For an investigative reporter like myself and for Bethany, that is the absolute dog whistle for drop everything and start investigating Philidor. Because if, when somebody's like, look, what we're doing is illegal, let's not discuss it, that is something as an investigative reporter I want to know everything about. I want to be in the middle of it. And so I, like a reporter, just dropped everything I was doing. I was investigating a couple of other companies in parallel to my Valiant work, and I dropped that stuff. I don't even remember what they were now. I began throwing myself into, what is Philidor? How is it so important to Valiant that fairly high-compensated salespeople are afraid of asking or discussing this with their bosses? And I hit the internet. I began making phone calls, dozens and dozens, and then a few dozen on top of that. What is Philidor? What is this company you can't ask about? And as it turned out, it was a pretty large secret right out in the open. What it was a drug distribution. If you were to see it the way Valiant wanted you to see it, it was simply a drug fulfillment or distribution center where you would call in and if you didn't have government insurance, in other words, if you were privately insured with, Aetna or Blue Cross Blue Shield or Travelers or any other healthcare plan, you could get your Valiant branded pharmaceuticals, specifically your dermatology products like Retin-A or Jublia for foot fungus or any of a number of other Valiant products. You could get those at you'd get them, next day, a 3-month supply for low or no copay, and they'd bill the insurance company. And if you're a certain kind of consumer, usually older or very busy, that's a great deal. You get your 2 or 3 months dropped right on your doorstep by FedEx by 10 a.m. and you low or no copay, sign me up. And it made sense. What people weren't seeing was that there was behind the scenes a very extensive multi-state effort to rig prices artificially high. What Philidor was doing behind the scenes was, to varying degrees, highly illegal. They had sought to register as a pharmacy in a number of different states to get around long-standing American rules about shipping drugs across state lines. Granted, these are not narcotics. These are topical skin type treatments, and they would try and register these pharmacies, and it was all very benign names like West Pharmacy or RNO Pharmacy, nothing that would, had any connection to Valiant. And they would use what they call the NPI, the national, it's the sort of the tracking number for pharmacies, allowing them to ship drugs across state lines. And that's how you would account for them at various insurance companies. They would be able to, in return for a low copay, they would bill the insurance companies these outrageous sums. I mean, Retin-A, for example, was a drug that had been developed in the early 1980s to treat acne and had gone through some controversies regarding, its effect on women and possible birth defects, and was selling for $15, $20 a tube until Valiant bought it and began, like Bethany said, jacking the prices up 30, 40, 50% a quarter to the point where it was selling for $900, $1,000, $1,100 a tube for effectively zit cream. And they would work out they would negotiate with insurance companies and get, they would list the price at $1,000 and take in $800 a tube. Something that cost them I don't know, 80 cents, $1 a tube to make and ship. And so you could see right away that if you thought about it, Philidor was Valiant's economic engine. It was the thing keeping a heavily debt-laden company afloat.
Bethany, what I want to ask you is, tell us what's changed with Valiant where it is today, and has anything changed overall in the market after all of this?
Well, so what changed with Valiant is a sudden wave of skepticism, starting with some of Roddy's excellent reporting, and you guys will come back to that or talk about that around the sleazy things they were doing. And it really was all of a sudden this facade just cracked, and people began to realize just how incredibly sleazy this company was. And Congress began to investigate what was going on with price gouging and called Valiant, among others, to come and testify about what they were doing to the price of drugs. But what's interesting is that here we are a couple of years later, and have things changed? Absolutely not. They really haven't. Congress didn't take any action on drug pricing, nor in reality will they probably ever. And big pharmaceutical companies continue to raise the prices on their drugs by double digits each year, which results in price increases over time that are of a huge magnitude. And so they're fundamentally, even though there was this huge uproar around Valiant and Congress investigated, and there was Martin Shkreli, and he was in the news, and he ended up going to jail, did anything change? I don't think so.
So I know in the Netflix, Senator McCaskill says nothing illegal was found. How could that have been? And we'll have the details with Roddy, but how could there have nothing been illegal found or something they could have taken action on? And where is Pearson now?
Well, that's an interesting question. It's a broader question to me because there's so much that goes wrong. These stories of business gone wrong, they seem so immoral that you think, well, there has to have been a law broken somewhere along the way. And the most dispiriting thing is when there actually isn't. And in some of the things that Valiant did, there may yet be some wrongdoing. But around the core of the business model, which was coming up with ways to profiteer from existing drugs and raising the price on these drugs, there's nothing illegal about that. It was perfect, if not morally acceptable behavior. It wasn't illegal behavior. And I think it's a challenge because drug companies used to just not do that. And in a world where anybody will do anything in order to make a buck, what sort of curbs are there on behavior like that? Pearson finally got kicked out as the CEO of Valiant, and I think he's still wrapped up in the legal mess surrounding the company. There are a number of investigations going on, and I don't think they're quite wrapped up at this point. And it remains to be seen what will happen to him.
Now, Ackman, when he testified before that Senate committee, said that the prices for Valiant would be now lowered across the board. Did that happen?
That did not happen, at least not yet for some of their most prominent drugs like cyprine and cupramine, these drugs that treat Wilson's disease that were small drugs but immensely profitable. The profit margin on those after Valiant raised the price to over $300,000 a year for cyprine was around over 90%. They were huge contributors to the bottom line. Part of the sad, tragic irony of this is that as Valiant collapsed, because Pearson had done so many acquisitions and had levered up the company with so much debt, in order for the company to survive, it needed every penny of profits it could produce. So it didn't have it no longer had the financial flexibility to lower the price of drugs and therefore reduce its profits. So this mousetrap Pearson built became a total trap for patients. Valiant promised to lower the price on other drugs, Nitropres and Isuprel, these drugs that are used for life-saving surgeries, by cutting these deals with hospitals. But at least as the last time I had checked, a lot of the deals they had promised had not yet materialized. So no, that didn't come true either.
The more things change, the more they stay the same. All right, Roddy, do you have any sense of what reforms would be needed, or what would you suggest should be done on this big pharma pricing, or the way Wall Street looks at this business? Would you suggest any specific changes after we just heard nothing's really been done?
Boy, I mean, that's a great question, Jim. I think the changes that are probably going to have to happen are kind of twofold. One, on drugs that are truly life-saving, especially those with communities of patients that are, under 10, 20, 30,000 number, you're probably going to have to look at some level of governmental/insurance company cooperation to keep price increases to something either that's manageable or to hold a certain price line. Because, as Bethany noted, even if you're a Rockefeller or Bill Gates or even LeBron James, $300,000 a year is a mighty, mighty large bill for something that 8 years ago was, $150, $200 a month. So I think that's one thing. The second thing is probably a little bit in that vein, which would be allowing governmental aid, like stuff like Medicare, Health and Human Services, to negotiate prices that are, more rational. I'm not saying price setting by the government. I'm saying kind of setting a bandwidth of prices that are acceptable. It's something that would, of course, allow a market to exist, as well as allowing a profit margin to be had by healthcare companies, but something that wouldn't bankrupt or at least trigger these alarms in insurance companies. Another thing probably would be allowing drugs to be imported from Canada in greater volume. That's something that is a bipartisan, it's being blocked in Senate, on a fairly regular basis. The healthcare companies spread enough money around Capitol Hill, and all of a sudden there are these tremendous fake concerns about the health and safety of people, whereas, Canadian pharmaceutical distribution and healthcare standards are, regularly exceed American. So allowing a marketplace to exist, perhaps even speeding up the generic approval process, things of these natures that would at least, at the margins have an effect.
Boy, it's a good point. I'm almost surprised that the government does not allow itself to negotiate for volume discounts on drugs. It would seem a logical usage of the leverage the government has. It's been a great story we've just heard. You can go and watch that Netflix Dirty Money series on Valiant, where you'll see Bethany and Roddy in it as well. And we want to thank Bethany McLean, Roddy Boyd. Roddy, tell us what your website is.
Sure. It's SIRF-online.org, surf-online.org.
And again, it is nonprofit. He does this just for basically keeping Wall Street honest, so you're free to make donations there because it's very good work he's doing in behalf of all of us that are investors. This has been Business Talk with Jim Campbell. Thanks to our national audience for listening. We'll see everybody next Sunday on Business Talk with Jim Campbell.